Hey, what's up guys? Welcome back. My name is Brad. I make videos about achieving true happiness through financial freedom, positivity, and hard work. Today, I want to talk about investing, especially for the beginner crowd out there that might be a little bit intimidated by the whole process. So the other day on Instagram, I posted a reminder to everybody that you had 1 month to max out your Roth IRA account. And I got so many DMs, people asking me questions about investing, which really got me thinking. I really get asked the same 5 questions by beginners when it comes to investing. Although I'm in debt right now and not investing as much as I used to be, before going on my debt-free journey, I actually did a lot of research. And I really learned the answers to these, and I understand where people are coming from when they seem a little bit confused or intimidated by the whole process. So what I'm gonna do is I'm gonna answer the 5 most frequently asked questions that I get from beginners about investing. And remember guys, when it comes to investing, you must do your own research. Don't do what your friend tells you, what your financial investor tells you, what I tell you. Do your own research. It's not that hard of a process. What I'm going to do is give you the framework and show you where to go do your research, and then you'll be able to make the decisions that are best for you, your family, and what stage of life you're currently in. The number one question I get asked all the time is, Brad, how do you get past just the jargon and the intimidation of the whole process? Like, do I need to pay somebody to do this? And there's all these books and all these terms. I pretty much remind people that when it comes to anything that can seem daunting or confusing, you must start simple. You do not need to be a financial expert to begin your investment process. Granted, there are a ton of things for you to learn along the way, but right now, at the beginning stages, there are simple things you can do right now with just a little bit of information and advice to get you started. And that, what you'll see, is really the important thing when it comes to investing. Getting it in early and starting early, and then you can learn along the process as you go along. There are very, very simple philosophies, which I'm going to get to in this video, but just remember, like the first time you got an iPhone, or the first time you did anything that was confusing, for me, the first time I had a child, you can't learn it all today. It's impossible. But you also don't need to know how to do everything to begin. When I got my iPhone, I learned how to call and make texts. I didn't know all the other features and apps I was going to be able to use, and even having an iPhone now, years later, I'm still learning. The same will be true for the investment process. Do not become intimidated. Right now, there are so many resources to you online, through books, through friends. You can find answers to the questions you have, and it does not need to be confusing. The next biggest thing that people talk to me about is the uncertainty in the future and feeling like investing is a form of gambling. I will be the first one to tell you, there are definitely associated risks, especially on the short term when it comes to investing. But you need to focus on the long term. I'm talking 20, 30 years out from right now. And if you do so, the market tells us that over the course of 20, 30, 50 years, the market is going to go up. Yes, there are going to be steep downs, but there's also going to be steep ups. But the trend is always going to be going up. Over the last 100 years or so, the market has returned about 7%. That's a really good return. That's almost a certainty, even with the associated risks. If you're really worried even further after hearing that information, there are more secure investments to make, like bonds and things like that I will go into in just a minute, where it gives you a fixed return which will not deviate up or down, and the risk is really, really low. I can tell you one thing that is certain about investing. If you don't, inflation is going to go up faster than what you're currently getting in your savings account. The money in your savings account is losing money every single day. Inflation is going to go up 2 to 3%. So unless your savings account is giving you 2 to 3%, that is guaranteed. You are losing money every single year that you keep money tied up in cash in your savings account. Now, should you have money tied up in cash? Absolutely. Once you're done getting out of debt, you should definitely have that 3 to 6 months saved up as an emergency type fund. And as you approach retirement, you should build that up to almost a year's worth in case there's a steep downturn on the year you want to retire or during your retirement. But in general, there is one thing that is certain. You are going to lose money if you hold cash in a general bank savings account, which is generally earning you less than 1%. And the banks can do this because they know people are intimidated. They know that people are going to keep their money in the bank as opposed to going out and reading a book or watching a couple YouTube videos or listening to a friend and beginning this investment process. The next question people ask me, oh, Brad, what do I do about all of the choices that I have? Well, let's break it down simple. You pretty much have three choices when it comes to investing. You can invest in vehicles such as stocks, bonds, or funds, which are generally mutual funds or ETFs, exchange traded funds. They all have their pros and cons, and the level of risk tolerance that you're willing to go through is really up to you. When we talk about stocks, you are buying a piece of an individual company. For example, if you invest in Amazon, you are a part owner in Amazon. Now, the problem with that is if something happens with Amazon and Amazon goes under, you go under with them. So when it comes to risk, there is a very, very high amount of risk when it comes to buying stocks, which you will buy through something called a brokerage account. Another vehicle that you're going to hear about is bonds. Now, what bonds are you giving money out as a loan to a certain business, either a corporate business or a government. And what I mean by that is a government agency or a corporation is going to seek a bond from a bank or from an investor. Let's say Vanguard. What Vanguard is going to do is issue that company a loan, a bond, and you are going to be the one that funds that loan through your investment company. So Vanguard is going to take all of the people that invested in bonds, collect that money, and then give that money out as a loan to a corporation or a government agency. Now with a bond, generally, you are going to get back a fixed return, which is not a lot, generally between 2 to 3%, which is going to keep up with inflation. And really the only risk associated with that is if the company that received that loan defaults and go out of business. But if you maintain these bonds through reputable companies like Fidelity or Charles Schwab or Vanguard, the chances of this happening are really, really low. So if you're a little bit nervous and skeptical and don't want to go with the associated risks, then maybe bonds are for you. The last and most popular are mutual funds. Now, what these mutual funds are a collection of stocks built into one fund. So they will have something called holdings in them. And when you look up the fund, you will see the holdings in that company. And pretty much what that means is what companies are embedded inside that stock. Now, kind of their cousin is this ETF, exchange traded funds. And the major difference is with a mutual fund, the price of that fund is set daily. Where an exchange traded fund, an ETF, that price fluctuates throughout the day almost like a stock would. Now you might hear about some people warning you against ETFs because you can trade them like stocks. Remember, we are thinking long term, set it and forget it. And with these exchange traded funds and being able to sell them and buy them on a daily basis, you might get yourself into a little bit of trouble. Before investing, you should know exactly what you want to do. Now, for the safest long-term investor, in my opinion, you should be going with mutual funds and something called an index fund, which are built into retirement accounts, which I'll go into in 1 second. Now, these index funds are going to track the entire market as a whole. You buy this index and you'll hear a total market index or something called an S&P 500 index. The major difference there is a total fund encompasses the entire market, where the S&P 500 just takes the top 500 companies in the S&P, and they are managed by the company that you have those investments with. One of the most popular mutual funds right now is the one through Vanguard. VTSAX is the company name, and it's very, very popular, especially in the debt-free community. But Charles Schwab and Fidelity, they're going to have something that's very, very comparable to that. And then people say, well, how many index funds should I have? Well, there is a stock market fund, there are bond funds, and there are international funds. So to diversify your entire portfolio, you might want to just choose a little bit of stock ETFs or mutual funds, a little bit of bond mutual funds, and maybe, possibly, maybe no more than 5%, some international bonds. With those three things, you will be well diversified and have a portfolio that touches a lot of different sectors and keeps your risk really, really low. The next question I always get is, how do I look at taxes and fees? Now, depending on the fund that you have, whether they are tax advantage funds or non-tax advantage funds, there are going to be different fees for both. And I'm going to try and explain them to you as simply as possible. You will hear something called a tax advantage fund, which are mostly your retirements, your traditional IRAs, your 401ks, your 403bs, and your Roth IRAs. Now, the major difference between two of these is, one, you get taxed and then you put money into these funds. Now, in those where you are taxed first, those will generally grow, and the gains that you earn can be withdrawn after retirement with no taxes associated with them. The other type is where you take money right from your paycheck, pre-tax, and it goes right in. It lowers your tax bracket now, and it grows over time. But later in life, when you retire, you will get taxed upon that withdrawal. And that might be a benefit for you because right now, when you're younger, you're earning more money, so you're in a higher tax bracket. So you would be paying more taxes now than later. So that fund is really, really up to you and which one you decide. Where are you at in your life? Are you close to retirement age or not? It doesn't really matter which one you choose. Just remember, you will either be taxed and then put money into the fund and it'll grow tax-free, or you'll put that money in before taxes and it'll grow and you will be taxed upon withdrawal. Now, as far as the companies are concerned, they might charge you a fee to hold on to those funds for you. These will be referred to as expense ratios, which is really the fee that the company charges you to maintain that fund. And every company and every mutual fund has its own expense ratio. The lowest ones I've seen are in the Vanguard funds, which are about 0.04%, meaning that you are going to pay 0.04% of that share every single year for them to maintain. There is one thing that you want to avoid though when it comes to these funds. Avoid at all costs actively managed funds. The fees on these funds are so high, and traditionally throughout time, actively managed funds never ever beat index funds over a yearly basis. These can start at 0.75% and range all the way up to 1, 2, 3% a year. So before you do anything, make sure that you are avoiding actively managed funds. You can do the research and you can do this on your own. And the last fee that you're really going to think about are these capital gain taxes that you will pay on the way out. And this will really depend on how that thing grows and, like I said before, whether it's a tax advantage fund or not. But I think you'll be okay and you'll figure that out. What you want to do though is you want to keep those funds for at least 1 year, because that will transition you from a short-term tax, which is your general income tax bracket, to a long-term capital gains tax, which is going to be 0, 15, or 30%, depending on how much money you make in that year, which is going to change over time. So you'll ask your accountant at that time when you want to withdraw the money, how much you're going to be taxed on that. I know for me, as somebody that's married, I can withdraw up to $72,000 tax-free in long-term capital gains tax. Those brackets are available online. Search long-term capital gains tax. And the last question that I get asked is, how do I manage risk versus age? And I think this is the golden question. And you're going to read things like, you should probably shift towards bonds as you get closer to retirement to avoid that volatility. I can agree with you on that, but you have to remember, this is your money and your life. You have to figure out how much risk tolerance you can handle. I've heard things like the rule of thumb being, keep your bonds percentage the same as your age. So I'm 37 years old. I would look to keep between 35 and 45% of my portfolio in bonds. But remember, when you hear that advice, that's traditional speaking, retiring at 62 years of age. If you start getting in now, you can take care of that and get done way before 60. So I can't say that I personally do that right now, even at 37 years old. That risk and age, that's something you're going to learn along the way. But like I said before, you're not going to learn it all today. Start with the mutual fund. Start with a Vanguard, a Fidelity, a Charles Schwab account, whichever you feel more comfortable about, and just get in. Start with a very, very simple Roth IRA in a very, very simple index fund and learn as you go. But remember, with these Roth IRAs and everything like that, get in now to use the power of compound interest. If you don't know what compound interest is, please look it up. And it's just too much for this video today, but that's really all I have. If you have any questions about this, guys, please leave them in the comments below. I would love to answer them. If I missed a tip or something, help out the community, guys. By no means am I a financial expert, and I know people out there know a lot more than me. I hope this gave you a general overview and made you feel less fearful about getting into the market. Until I see you on the next one, guys, stay positive, work really, really hard, and be kind to others. I'll see you on the next one.